ha sido una de las verdades emblemáticas de los mercados, pero la crisis del último año ha levantado interrogantes ante la posibilidad de escenarios de elevada inflación en Occidente en los años por venir. Esta tarde, Cash Flow Management, Regulation or Pandemic. Which is the true margin killer? Tom Severance, Global Head of Account Management and Sales de Institutional Cash Distributors, ICD. Marcelo Rodríguez, Vicepresidente y Tesorero Regional de Scotiabank, Canadá. Y como anfitrión, tenemos el honor de presentar a Suresh Sankaran, Head of Model Risk Governance de Metrobank de Reino Unido. Agradecemos a Murex por hacer posible esta mesa redonda. Welcome Tom, Marcelo, and Suresh to the Risk Management and Trading Conference 2021.
Good afternoon, and welcome to the panel, which is titled Cash Flows, the Pandemic or Regulation, which is the margin killer. I'm very glad to welcome my esteemed panelists to the show, and I want to start off by talking about regulation. From the beginning of 2021 until the 6th of June, there were 8,834 bank-specific regulations issued worldwide. And the breakdown essentially is largely between the US, the Eurozone, the UK, and the UK accounted for around 940 regulations and occupied the 4th position. If we consider these for the period from 1st January 2020, then we get around 23,000 regulations, bank specific. And again, the UK is responsible for around 2,600 of them. Therefore, during the time when this country, the UK, was grappling with the impact of a devastating pandemic, our regulators were still issuing close to 2,000 regulatory pronouncements. It is not for nothing that the country is regarded as being practical regulators. Canada, Australia, Japan, New Zealand had the lowest number of regulations in the same corresponding period. And this is, I believe, for a very good reason. You let the system come out of the grasp of the debilitating pandemic before you put the regulatory boot back in. With that introduction, I want to start the panel by asking Marcelo. Marcelo, what do you think? Have the regulators been remiss in having so many regulations, or is this business as usual?
Well, I guess we have to see this trend from a long-term perspective. I will typically describe the banking system pre-2007, 2008, and 9 crisis and after. And since then, since that crisis was already over in 2009 or 10, a new world for bank started with heavy regulations in all aspects of the businesses, making it way more expensive to do banking. Not only because of new regulations, but also because simultaneously we were experiencing in those days the lowest interest rates ever worldwide. So, banks were facing, on the one hand, a reduction of net interest margin because of the lowest interest rates in decades. And on the other hand, incremental costs because of the new regulations being introduced. That hasn't changed fundamentally since 2008 and 2009. And now this new situation, we're just facing the pandemic situation, is actually exacerbating some of those headwinds for banks. To me, the market is clearly seeing this as a headwind for the banking system as a whole on a global scale. I was just looking at this morning, for instance, some indicators such as the banking ETF in the US, the XLF, which compiles most banks trading publicly in the US, and it just reached the same level in terms of pricing of 2006. 6 months ago. So it was virtually 15 years where the average price of banking shares is reaching the same level as 15 years before. During that same period, you will see that the S&P 500 more than tripled. So that is telling us the banking business is not as good as it was before. And from my perspective, what I can see is that we will face non-intended consequences of excess of regulation, same as we faced non-intended consequences of lack of regulations before. I typically will say that we're swinging from virtually no regulations to excessive regulation with too little regulatory environment. Let's put it that way. We created banks that were called too big to fail. But now, because of the excess of regulations, we are killing those banks that are too small to compete, because the fixed cost of doing banking are extremely high right now. So I'm really hoping we can get balance sooner rather than later.
Thank you very much, Marcelo. Tom, one point that Marcelo made, which is very interesting, was the comparison to 2007, 2008. At that time, we as bankers were squarely to blame. So mea culpa was perfectly acceptable. Today, it is a virus. Why are we being held to ransom because of a virus through excessive regulation?
Well, it's a fantastic question, and I think if you're sitting on the banking side, you're wondering why us. There's no credit crisis here. There's no problem. We didn't cause any of this, and at a time where we're being asked to take the burden and bring on all the assets that are being created by these governments and provide liquidity to clients, provide return to clients. In a market where we can't make any money, it's very difficult, right? And so I think from the banking perspective, I look at the regulatory environment in the US, and we put all this money into the hands of the individuals and a lot of the businesses, and they have no place to put that money, right? The money market business grew almost 250%. The deposit business exploded, both individually and from corporate deposits. And that's because everybody pulled down their revolvers and all of the CARES money that came in. But at the same time, you have regulation that penalizes the banks for taking too many deposits. And so they did do a good thing, and they did react. During 2020, they exempted deposits from the SLR, which was an absolute critical piece for the banks, because otherwise they would not have been able to take any more cash, and they would have lost even more money than they're going to lose now. But that exemption went away in March. So here we are back to a position where banks are being asked to help not only corporates and everyone else who have cash, but it's citizens, and then at the same time being penalized for doing so. So I wish I could answer your question, but I can't.
Let's we'll keep that dignified point wonderfully well presented, and we'll move on back to Marcelo. The third point within the topic relates to cash flows. So we highlighted the impact of the pandemic, and we talked about excessive regulation. Where do you think cash flow stands in the margin killing episode, as it were?
I would say we also need to separate two different moments in time, before the pandemic and after the pandemic situation. Before the pandemic, I would say most banks were trying to manage their cash flows according to prudential liquidity measures and regulations. After the pandemic hit, however, and this is the first time I see something like this in a number of countries, in I can say dozens and dozens of countries, including Mexico. Most central banks globally, on an orchestrated way, were making sure that liquidity was there. So there has been an incredible amount of liquidity injected to the banking system, making sure that liquidity was not an issue. And I believe that move was smart, was timely as well, because it was done at the very beginning, trying to separate liquidity problems from solvency problems. And the way I see banks will face challenges going forward is what's going to happen when things get back to normal? Because as we speak, most balance sheets are inflated because of easy access to money from central banks. And as I said before, this is going on in a huge number of countries across the globe. So when this situation starts normalizing, I believe we will be facing a number of challenges, and we need to get prepared for that moment in advance.
Yeah, I'd like to jump in on that if it's okay, Suresh, because it's a very interesting thing. There's if you look at the amount of money that was put into the money supply in the last year, 2/3 of the money that today is in the money supply was created in the last year. It took 100 years to get that first third, and in 1 year we created the second 2/3 that's in the money supply today. So that tells you there's an enormous amount of cash in the money supply that has just been put there by these governments. And just last week, the US changed their overnight repo rate to be 5 basis points. The first day, they traded $800 billion on overnight repo, which is a staggering number, right? And that's the only place you can get any sort of return. And this is what's happened is we've created all this money in the money supply. And I don't know how the world's going to pay for this in the future. I think we're boxing ourselves in a bit here.
And again, both of you brought out a very, very valid point, which is that as things turn to normal. And so I want to ask you first, Tom, and then moving back to Marcelo. Do you think the pandemic has had its say? Or is there a 4th, 5th, 6th, 7th wave yet to come? What do you think?
Well, I think if you look at corporate cash, corporations got hit very, very hard by this pandemic. In some, obviously benefited, but others were taken by surprise and did not have enough cash to run their business and had to get bailed out per se, or take loans, or the government acts. And I think what we've seen in the money market business is that these corporations are still maintaining almost half again as much money in their cash balances as they had before the pandemic started. And I think that's going to stay. I don't see people, I think the concern about this kind of a pandemic happening again is there, and people are going to keep money more liquid than they have in the past. Which means, again, less return, shorter interest rate, and makes it harder for the banks to be making money, right? Especially in a zero interest rate environment.
So Marcelo, just to add on to that, we can agree that the governments have been very proactive in ensuring that the markets were adequately liquid. And at the same time, regulators were lax in the sense that they were over-regulating. In this world of wafer-thin margins, do you think it is counterproductive for the regulator to be so intrusive?
I believe we need to find the balance, and that's difficult to find. When we went to university, I still remember, you're always assuming that the price discovery mechanisms are making sure that you find the fair value of any given asset. It might be an equity, a home, whatever it is, right? And then after a number of years outside of university, I can say markets are very unusually balanced, and they are overvalued or undervalued, right? It's typically that case. So with regulations, it's more or less similar. I believe we went from an extremely light regulatory environment to an extremely heavy regulatory environment, and that has economic costs because, of course, we banks need to find ways to pass those incremental costs over to customers, right? That's our business. We have to protect our business as any other corporation will do. I believe and I hope, I really hope that we're close to that point of holding back more and more regulations, and we arrive to a sort of a broader view of what is better for the community as a whole, because introducing new incremental costs to the financial system is a cost for society.
Tom, you talked about overnight rates being 5 basis points. In many regimes, we are seeing negative interest rates. We're seeing in the UK, the US itself, Hong Kong, Japan, Singapore, some parts of the Eurozone are seeing negative interest rates. Do you think this will also play into the excessive cash element that's seen in the markets? And so liquidity will be even more easy. And as you said, it'll be a challenge to deploy.
I think that, well, for one, negative interest rates actually allow banks to charge fees. Zero interest rates pretty much allow banks not to charge anything. So negative interest rates can actually help a little bit in terms of the banks making money. In terms of are we headed toward a long-term negative interest rates or even negative at all in the US? I think the Fed is concerned that we go negative and do not want that to happen. I think that you're going to see some intervention like we saw. This was the overnight rate going up was not announced. It was not a, I mean, it was announced, but it isn't a policy. It's a mechanism that they have that they can use, right? So they just said that instead of the overnight repo being 0, they're going to move it to 5 basis points. And so they didn't change their official policy from the FOMC meetings. They simply just moved the overnight rate up. It's still between the 0 and 25 basis point target that they have, right? It happened to be at 0 before. They've just moved it up a little bit. And that's to give some relief on the short end, where there's a lot of challenges for the banks to be making any money at all. And that's where a lot of the money flow is. There's trillions of dollars in the short end right now. And that money making 0 is not good for the economy. It's not good for the banks. It's not good for the investors, right? So I don't think the U.S. government is going to allow that to happen. And I'm very curious to see what happens in your country. I'd love your perspective on that because, you know, you've been hovering at 0 and, you know, dipping into negative during the day, but not going there. What's going to happen in the UK?
Oh, well, it's very simple. We can't afford negative interest rates. Just like we can't afford a low interest rate regime at this point in time. There is clamor to increase interest rates because the markets are sufficiently buoyant, I think, to the real economy is actually doing quite well. If anything, there is enough evidence to suggest that we are thoroughly vaccinated, are socially distant to death, more or less, and so we are back ready to face, close proximity in closer confines, as it were. And this will basically mean that there has to be a shift somewhere in interest rates. This will be contrary to the current governmental policy of non-interference. And so it'll be interesting to see who will make the first move, because as you know, Tom, England is governed by a tripartite structure. There is the Chancellor of the Exchequer, who you call the Finance Ministry, who sets policy. There is the Bank of England, which sets interest rates. And then there is the PRA, which regulates financial institutions. And therefore, if they can ever come up to talking to each other, I really believe that something constructive can happen. But the last time they talked to each other was when Northern Rock fell by the wayside. And so I wouldn't hold my breath on that one. And just with that point, Marcelo, I want to move it back to you to say the regulations in 2008 were a reaction to banker greed. They were a reaction to the failing markets. They were a reaction to toxic derivatives. Why are we seeing the same reactiveness now? Or do you think that the regulators are becoming more proactive, and are they trying to direct markets through regulation?
It's hard to say, but my personal perspective is it's an easy and compelling popular argument. Punishing bankers, punishing greed, punishing these wealthy individuals deciding where the flows of money are going to go is a quite compelling argument from a political standpoint. So I believe that there is a lot of that in what we see today. It's very difficult to say today that any bank, globally speaking, will have the room to abuse the system as there was before. We have to admit that before 2008 there were certain excesses, right? So, but it's hard to admit that that is actually even possible today, right? Because of the amount of regulations and controls that have been implemented. However, it continues to be a pretty compelling political argument in any given Congress. And we're seeing this all across the board. I'm interacting with at least 15 different countries on a regular basis. And I can tell you that most of them, or in most of them, we see this trend of introducing cap to interest rates, introducing floor to savings rates, introducing mobility from bank to bank, facilitation for customers with no fees, waiving any breakage costs and so on. So, it's all across the board. I can see that it sounds like a very easy to sell compelling argument in any given Congress. Like, we need more money, we need more taxes. Okay, bankers can pay for it. It's pretty easy to say that.
Very, very well said, sir. Tom, I mean, from a US standpoint, when Basel II was introduced, the US was very reluctant to play along and accommodate this regulation as part of their it is too complex for most of our banks. And that was the rationale. Having said that, how do you account for the fact that in the recent set of regulations that have come through, the US actually leads the way with close to 3,500 regulations in the last year? Is it 4 years of Trumpism catching up, or is it a new sheriff's in town?
Well, I'm curious to see how this rolls out, because if you look at the regulations that were put in place and the stress tests that banks were required to do, and all of the work that happened after 2008, a lot of the banks were penalized for not living up to some of the standards, and maybe not heavily penalized, but they had to go back and rerun their stress tests. They had to go back and get fined for certain pieces. And none of those, as we know, risk management is an extremely complicated problem. And when you try to do it at the size of a global bank scale, it becomes, even more complex. So there's no simple answer to putting in regulation. Why this is happening in this environment right now, I don't really understand. The banks are in good standing. The banks have no credit risk at all at this point. They're way over, they've got more deposits, more money than they need at this point. They're not very profitable at this point. I mean, they're getting more profitable, but that has to do with the fact that there's nothing to trade. There's no way to make money. So I'm very curious as to why the government has decided to, slam a whole lot of things in place. I will say one thing that's interesting is that when you have this kind of momentum shift, you have the Trump to Biden shift, and Trump was a very alienating character, to say the least. I think people feel like we have an opportunity now to take advantage and move things, think of a pendulum going from one side to the other. It swings way over, and then it's probably going to swing back, but I think it might swing back a little slower this time. And we're going to be regulated. We're going to be heavy, big government. An interesting stat, the most recent CARES package, which was 2.9 or $1.9 trillion, 9% of that had relief for COVID in it. And it was a COVID relief package. But only 9% of it actually had money for COVID relief money. So it's using what, is the current environment to do what people want to do and can get away with at this current time.
Marcelo, I mean, you come from an economy where the regulator is considered to be one of the most mature. Why do you think the Canadian regulator has found that middle ground with the regulations to ensure that they are tracking banks' progress in a non-intrusive fashion, as opposed to being a referee actively involved in the middle of the game?
I believe that's related to Canada, for the most part, avoiding the credit crisis in 2007, 2008. So that provides sort of a more solid ground to evolve with regulations. Countries that were more affected, the US, for instance, or the UK, in addition to Switzerland and some others, where government funds were needed to keep certain banks alive. That didn't happen in Canada, right? So there is more pressure in those countries than in Canada. In Canada, there is no need to punish bankers as much as in other countries from a political standpoint. So I believe that's behind this more, I would say a softer approach, a more sort of a gradual implementation. I can tell you by my own experience, there is a lot of interaction, before any regulation is released, analyzing the impact that any given change or innovation in terms of regulations will have all across the spectrum of different banks. So that's the way I see it. It's just because the cost of facing the credit crisis was way lower than other jurisdictions.
It paves the way for very mature thinking. And moving on to the real economy, Tom, do you think that inflation, which is seen around the world now, is a temporary issue and was caused by a pandemic, or is it a real imminent threat worldwide?
Yeah, I think that's a fantastic question. We certainly know year over year inflation is extraordinarily high. If we look back and compare to 2019, inflation is around 2.2, 2.3% in the US relative to 2019, which is high for US standards and above the Fed's preferred rate. But the Fed has also said they're going to be relaxed on this and let it roll for a little bit. If we continue to see supply problems, you're going to have inflation. Right. So we have chip problems for cars. We have chip problems for machinery. So there is a supply issue, which is driving up used prices, used car prices, used machinery prices. Oil prices were somewhat arbitrarily high because production was low. And you can solve that one pretty quickly by producing more oil. And it seems like that's partially what's going to happen. It's going to keep prices where I think both the producers and the buyers are comfortable. So I think that will even out. But I do think we've got a lot of money in the economy that people want to spend. And it's a lot, that 2/3 of the money was created in the last year comment. Where's that money going? It's got to be used for something, and people are going to want to use that to buy product, right? So I do think it's real. I don't think it's 4.5% or 4.3% in the U.S. right now, because I think that's a little bit arbitrary, but based on the 2020 to 2021. But if you look at 2019, we're definitely have some inflation, and I think it's a bit of pent up spending as well.
So, Marcelo,
and if I may elaborate about the same question, which is fascinating, and I will say the intellectual and investors community are divided in that point on whether we're going to face serious inflation pressures in the next few years or not. And I tend to believe that the conversation has to be actually more granular. So far, we don't see material consumption inflation. However, if you look at the price of assets, they're in all-time highs, and by far. I mean, if you look at the S&P 500 in terms of price earnings, for instance, it's 10 years ago, we wouldn't have believed that.
Exactly.
It wasn't even possible. If you look at real estate, on the other hand, all of the actual, what I call investment assets are in all-time highs. So I believe this discussion about inflation has to be way more granular and distinguishing. What are we calling inflation? Because we may not see that shirts and shorts are getting more expensive. That's true. However, getting real assets is becoming more and more expensive.
And just to follow up on that one, it has been argued by many economists that the only way to beat inflation is to have infrastructural spending. Given the money that Tom talked about floating around in the marketplace, do you think there will be a move by most countries to don a socialist hat and start thinking infrastructure projects as opposed to private, hoping for the private sector to do its bit? Marcelo?
Well, that's exactly the prescription that was used after the 1930s crisis. That was exactly the prescription, and apparently that's exactly what's going to happen now. We are, getting out of a serious problem of debt. We're creating more debt, and we will need to get out. In order to do so, I believe infrastructure is one of the answers. It has been proven before. In combination with more taxes, with more influence and involvement of the government into the economic arena. I was talking the other day with a colleague exactly about that, and many people forget that in 1933, actually, Mr. Roosevelt in the U.S. confiscated gold. Gold was confiscated, so there's no safe assets. We were talking about this because of certain new tax regulations being revisited in both the U.S. and Canada. Real estate prices are going up. Yeah, taxes are going to go up too. That's for sure. They are going to tax whoever has the wealth, right? And to the extreme that has happened before with the confiscation of gold in 1933. So the answer is, I believe we're going to go more or less along the same lines the U.S. went after the Depression of 1930s.
Tom, do you think that's a possibility, the U.S. going socialist?
Well, I mean, the U.S. going socialist is kind of like, the UK moving a little bit to the left, right? We're already so far right compared to the world. Moving socialist to us would be actually having, healthcare for everybody and stuff like that. But more realistically, I think when you think about what Roosevelt did with what was called the New Deal at the time, he spent his way out of depression with infrastructure projects, which employed people, which built up the economy and the infrastructure to then have roads and connect people and all that. I think you'll see some of that. There might be a bit of a backlash against supply chains at this point. I found it, yes, we're trying to move more towards climate control and worrying about climate change, and we kind of cost Canada a lot of money on a pipeline recently, but those type of things, I think, is where the spending is going to go. We have all the roads we need. We have all the connectivity we need. What we need now are kind of nuts and bolts for the new economy. So we need, chip manufacturing, and we need, climate change capabilities and things like that. So I think you'll see a lot of that, and certainly the Biden administration is pushing on that. So we will definitely swing further socialist, if you want to think of it that way. But I think our left is still pretty far right of most countries.
That is true. That is true.
I will agree. I live in Canada, so I agree.
And, Marcelo, this cost of regulation that we talked about. So the banks have to implement. There is no choice. You're not given an option that says I'll do it next year. So these regulations are coming in like an avalanche. Who bears this cost?
Well, it's a combination between the shareholders of any financial institution and the ultimate customers, because you have to reprice things. It's in these days you will see that it's becoming more and more difficult to waive fees on any given service, which was more or less a common practice before. It's a combination of those two holders, the stakeholder on the one hand, and then the customer, the ultimate customer on the other. That's why I at the very beginning, I believe it was the first or second question, I said all of these costs, if they are redundant and unnecessary, and there is many of those, at the end of the day are being paid by society. It's the ultimate customer is making the financial engine more expensive, and there is a reason why in banking we use so many terms borrowed from biology in connection with the circulatory system, right? We use liquidity, we use circulation, we use all of those, and it is because of that we banks and the financial system as a whole are a sort of the circulatory system of any economy. So the more you introduce, barriers between the different compartments, belonging to this system, the more expensive, the more costly it is to move and to continue moving this mechanism.
Yeah, I think there's an interesting dynamic. If you look back at maybe 5 years ago with XVA and FRTB coming in, a lot of the costs became transparent. And when those costs started becoming transparent to both the buyer and the seller, then banks made a determination as to where they could make money. And many banks got out of certain businesses, and other banks went into those businesses, but we shrunk the number of players in each of those businesses, which by definition means that you end up with less players, higher prices, and everybody ends up paying a higher cost for those services. And with more regulation, you're going to see the exact same thing happen. It's just gonna end up in the consumer's hands, and the consumer is going to pay for that cost.
Now, forgetting about the regulation for a minute and just moving away, one of the things that I've noticed with some disappointment is over the last 30 years that I've been an active banker, the cost to banking has not really come down. Or the telegraphic transfer still takes the same price. There is really nothing that is offered as a freebie anymore. Has the banker lost its creative juice? I ask both of you.
I believe we are in a sort of secular change, I will say, because the banking system has been innovating for the past, I would say, 40 years a lot, starting with ATMs. There are some people that actually say that that is the only invention that bankers have made over that period of time. But starting with that, ATMs, online communications, the ability to move money online real time. And now we're evolving into payments using the phone to pay. I was actually talking with an executive the other day about an experience I had with one of my kids. I gave him a credit card, and he was like, what? He tells me that I'm not going to be paying like a nerd. I don't use credit cards. And I still remember when I was young and my dad was trying to force me to use traveler checks to go to Europe. I was like, I have a credit card. I don't need traveler checks. You know what I mean? It's exactly the same situation on a different scale. So I believe, all of these innovations and in combination with technology are making the banking system more affordable. And I guess that's where the big opportunity for banks is. Not only in the developed world, because in countries like Canada, 97% of the population are already in the banking system, but in the developing world, that situation is different.
Tom, your thoughts?
Yeah, I think one of the things that we overlook as an expense, which is an enormous expense and getting bigger and bigger every year, is the cost of security. And as we move more and more everything electronic, that cost of security moves higher and higher. And you see, all of these companies that are held ransom in the last year being shut down by, some black market person or black market group that is, shuts all their computers down. They pay $10 million and they're back up and running. Those are real threats. And banks have to spend more money than everyone else, because they're sitting on people's money, they're sitting on people's private information, and they're transferring cash. So that cost is becoming a cost that is, outweighing most other things in the system. And I think that's something that we really have to keep an eye on going forward, because it's not going to get easier, right?
As we enter the home stretch for this panel, I'm going to put you in the spot, both of you. So we had three. There was cash flows, there was regulation, and there was the pandemic. Pick one. Which has been the margin killer for you? Marcelo, we start with you.
I will say, it's hard to say, because it's, as I said, a combination of interest rates and regulations or cost of doing business, if you will. I will say that given that interest rates are not going up anytime soon, that's what I think. It's the cost of doing business or regulations.
Perfect. Tom?
Well, I would say for the business I'm in, which is the short-term money market business, we have 400 odd customers who use that cash on an overnight basis. Zero interest rates has really had a major effect. And that was pandemic started, but maybe regulation, Fed continued, right? And so I think it's that combination of reacting to something that took place in the market and then waiting to see when we can pull out of it. And I think this reaction is being unprepared and reacting, I think, has made it so that now regulators are very concerned to overreact on the other side.
Thank you very much, Marcelo, Tom. And I'll end up by talking about a combination of the pandemic, the cash flows, and regulation. the most profound set of regulations being passed are right now. Basel 3.1, the delayed FRTB, XVA, the SACCR. These are landmark regulations that are being proposed and implemented right now. The pandemic has given birth to a whole series of freebies from socialist regimes like the UK, where you've got loans, bounce back loans, affordability loans, for which the government takes guarantees. And so the bank has really no incentive to target defaulters. And then you have cash flows. Banks are sitting, as Tom alluded to, and as Marcelo said, we are sitting on a pile of cash. We don't know what to do with it. So, to paraphrase a Chinese curse, may you live in interesting times, is set to come true for all of us. I thank Marcelo and Tom for their wonderful, wonderful contribution to the panel. And now I'll open it up to questions. I'm sure there are audience questions that are winging their way across from Gerardo, so we'll wait in here.
Ya me llamó. Marcelo, it's been great hearing from you. As usual, you have given us a great discussion. I would expect nothing less from three veterans of the Risk Management Training Conference.
Hey, I am only 34 years old.
Well, Mr. Suresh, do you remember the time you were here at the World Cup, the last World Cup, I think,
yes.
And you wore a Mexico
t-shirt.
Exactly, a Mexican t-shirt from our national team, because we were going to watch a soccer match. I think it was Mexico against South Korea or something like that. And Marcelo, you were with us from the very beginning. Probably you remember those small classrooms in a hotel near Mexico City downtown before we moved to the outskirts of Mexico City to a business neighborhood with wider rooms, a much bigger event, and something like that. And Thomas, you have been here, you have been with us in the person-to-person event and in the online event. The three of you have traveled this journey with us for the last few years. It's great. I think it's great and it's fitting that it's the three of you that are the protagonists of this last panel in the Risk Management Training Conference 2021. Absolutely, I think there are some questions that we could raise, and the audience eager to ask about two issues. All of you talked about inflation and interest rates. And inflation, who can deny that? Inflation is an ongoing discussion all over the world, because of the rescue packages, because the pandemic was a simultaneous shock on demand and supply, and demand is recovering faster than supply can meet demand. And that's why we are having inflation. Should we be concerned, not in months ahead, but in years ahead, of an inflationary spike in the Western economies and therefore across the globe? Who wants to take this up?
Maybe I'll start and then I'll let the other two jump in.
Okay.
I think if we don't react and start to quell some of the issues, we could spiral into a long-term inflation issue. I happened to have a carpenter here this morning, and he said, you know, a year ago, a piece of plywood was $20. Today it's $80. He said next week it might be $85.
Wow.
And there's all sorts of arguments as to whether it's because you can't get people to work, whether it's because there's not enough supply and because the machinery wasn't running during the pandemic, everything shut down during the pandemic, and nobody realized that we would need all these resources so quickly and it's come back quicker? Or is it really just that there's that much money in the supply and people are using that money, which is driving prices up? And so I think we need to be very careful globally to manage any overinflated situation so that we don't end up in a long-term spiral that we can't control.
I will tend to agree. I mean, as usual, when we're forecasting any given economic indicator, we only can outline the risk, risk of inflation versus risk of deflation. And I would say it is clearly inclined towards inflation. That's not to say we will see inflation, but of course the balance of risks is towards that end of this balance. As I said before, I believe though that we have to have a very, very granular conversation about inflation, globally speaking, because we tend to refer to inflation as whatever the price index is in any given country, which is nothing else than a basket of goods and services that's supposed to represent the consumption behavior of any given population. When you dig further into it, you will see that some items are going to be more exposed to inflationary spikes, as Tom was saying. And construction materials here in Canada are flying too. I mean, they have almost doubled over the past 12 months. So in certain specific segments, we will see and we are seeing inflation. That doesn't mean that the basket of goods and services is under a significant pressure. However, to me, assets are reflecting that there is a risk of inflation ahead. When I say assets, as I said before, I look at the real estate and equities, or even bitcoins, if you will, right? It's whatever real asset is worth as much as double as it was 2-3 years before, right?
I was speaking to my grandmother the other day, and she said to me that those were the days I used to go to the market with a purse full of money and get a bag full of vegetables, and now I'm going with a bag full of money and getting a purse full of vegetables. So inflation is alive and well, and it is hitting us where it matters most, in the real economy. And as Tom, you and Marcelo both have alluded to, unless steps are taken, this will be a long drawn stretch, which will continue for some years to come, Gerardo.
Okay. As a follow-up question on this, I have to ask, in inflationary times, cash is hit hardest of all the asset classes. And it has actually been one of the reasons that some analysts say that that's why we have a commodities rally, for example. Investors are moving to asset classes that can adapt to inflationary spikes faster, like commodities. Are we going to be seeing that in the next months to come? And more generally, gentlemen, is still valid this phrase that we all learned in business school, cash is king?
I believe so.
Okay.
I believe so. And what we're seeing here is, from my perspective, in the global markets, investors are trying to get rid of long-term monetary assets, meaning securities, bonds, whatever is money market, whatever is fiat money, and trying to get hard goods. Like I was reading an investor the other day, an investor's note, saying, recommending you have to buy whatever is a hard asset, nothing monetary, hard asset, whatever that, if it falls in your feet, it hurts, including gold, including metals, including oil, or whatever else has real value, right? So I believe in that context, cash is king. People are expecting for something to happen because there will be reactions and there will be opportunities ahead, and being ready to take and crystallize those opportunities is going to be important.
Tom?
Fiat currencies essentially will rule. And so there will never be a situation where cash will not be king.
Okay.
And that it could change. The flavor of cash could change. Last year, there was a huge rally on Bitcoin before there was a collapse, equally as staggering. And so the flavor changed, but it was still cash or cash equivalent.
Okay. Tom, your thoughts on this?
Well, I think the coin thing, I find it very interesting right now. I think there's going to be some very big winners and some very big losers, but it is becoming a currency, and it is being treated and looked at and used like a currency. So it is becoming a cash equivalent. Which one's going to prevail and where and how, I think, still remains to be seen. But I think the other dynamic that is driving one of the challenges that we can't understand is that people don't have any place to put their money, right? And with a lack of, there's no return in bonds, there's no return in any sector like that. So for a lack of a better place to put it, they're putting it in stocks. And we were talking about the all-time high of, price to book and all of that. And with, zero interest rates, all of these companies can borrow money at zero and go ahead and invest that money in their company. So I think there's almost you've got the stock market rising like this, you've got inflation going up, there's no place to put that money. Yes, we'd all like to maybe put it in some sort of a hard asset, but what hard assets are the ones that are going to make sense to put it in, and what's going to happen to them? I mean, this is a dynamic that I don't think we've really seen in history, with this much cash and no place to put it, with inflation rising the way it is.
Okay. Tom, you just said a phrase that I love. We are facing things that we have not seen in history. The three of you are veterans in markets and veterans in the Risk Management Training Conference, which is an education event. Do we know everything that we know to face the challenges of the future, or are we going to have to keep learning in years to come? This is my final question.
Gerardo, a lovely American called Donald Rumsfeld talked about known knowns, known unknowns, and unknown unknowns. And that didn't resonate with me then. But as time has gone by, I really see the value of the unknown unknowns and indeed the known unknowns. And so in an event like this, which I believe is an excellent forum to bring people together, share ideas, whether they are conservative ideas, whether they are heretical ideas. These ideas are the seeds of creation. And this creation will lead to solutions for challenges that we are going through, and in unprecedented times. The challenges that we are facing right now, as the topic suggested, was the cash flows in abundance, regulations in excess, and the pandemic that is raging and showing no signs of abating. And so conferences like these are absolutely crucial in order to understand those unknown unknowns, or at least discuss them in a heretical fashion in order to prepare for it. I'll turn it over to my two co-panelists.
Tom,
I don't know if I can top that, because that was extremely well said. But I will say that the emergence of modern technologies to look at these problems is making it easier for us to simulate some of these things. So if you look at what's happening in AI, you look at what's happening with neural networks, we're able to do more today than we were 15 years ago, 10 years ago. And that allows us to maybe get a little bit ahead of it compared to what we used to be able to do, but it's still all new. And so we're in a learning process. Marcelo?
Yeah, I will say that even we were called, and I feel like a veteran, that's for sure. I also and simultaneously believe that the global economic and financial system we have is new in nature. I mean, all of what we know started after the abolition of Bretton Woods in 1971, with currencies trading from one place to the other, influencing the global economy. So I'm convinced that we will continue learning as we go.
Okay. Mr. Suresh, Tom, Marcelo, it's great. It's been great talking to you. Like we have been talking to you for the last few years, and I really hope that we can continue talking to you about the current issues in finance for years to come. Thank you very much for being the final panel in this Risk Management Trading Conference 2021. See you in the future, a future that absolutely has a lot of challenges and a lot of learning to do for us. Thank you very much.